Hello, everyone. It is Bill, Wendy, and Jonathan with Carolina Capital Management. Thank you so much for joining us today. This segment of our broadcast is the Big Ugly Questions.
It's called Ask an Ugly Question Session.
And get an ugly answer.
Yeah. Well, hopefully the answers aren't ugly, but they might not be what you want to hear, but they'll be the truth, right?
Yeah.
Right. That's the thing. So we were talking about Jonathan's hippie hair earlier. He's got that corona thing going on.
You don't know which side there.
I know. You're like a long-haired hippie freak. That's awesome. Making that statement, right?
I feel weird getting my hair cut with a mask on. So it's like, I just.
How do they cut your hair with a mask on? That's got to be.
I have not found out.
I'll do it for you.
I have. It's not a big deal. So before we get started, too deep into this, don't forget to like, share, subscribe, and we are Carolina Capital Management. We do two things.
And that's all.
We are a lender. We do short-term bridge loans for residential and commercial property types, but only to commercial entities.
Right.
If you're interested in borrowing money, you can go to carolinahardmoney.com and click on the borrower tab. We also have investment opportunities for those who want thinner wood. We call it paper. So you can invest in the notes or invest in our fund. Go to the same website, carolinahardmoney.com, and click on the investor tab.
That's right. And tell all your friends.
And by the way, we're going to cover a couple of questions here. If you have any additional questions yourself, you can put them in the chat.
I'm really excited about this too, because we just started this last week, and I'm really shocked at the response we're getting from people on this. I've got several emails after it was over asking me more ugly questions.
And we welcome them.
Yeah.
Most of them had to do with Jonathan's hair.
Yeah. It's just really neat that this has sparked a lot of interest, because you go to anybody's website, and on their website you're going to see everybody banging their chest and talking about how great and wonderful their product is or their team is or whatever, and we fall into that category too. But what people really want is answers to their questions, unbiased answers to their questions. So that's what our goal is with this, right?
Listen, every lender and every fund manager, investment opportunity are going to be different, right? Yeah. So there's always a variety of questions to be asked and answered, because it's not always a good fit.
It's not one size fits all, right?
And especially in lending right now, if you're trying to get a commercial loan, you're getting a lot of lenders that are saying we're not lending, or we're lending, but we're doing limited property types,
right?
Or we really don't want to lend, but if you pay this, sure, we'll lend.
If you're willing to be this crazy.
And typically the people that aren't lending or not lending well are the ones that rely on the secondary market to sell their product. The balance sheet lenders, and that's true with private lenders too. They're balance sheet lenders. They have a platform or a balance sheet. They're keeping those loans on the books. They're not selling them off. Those people, for the most part, are still lending. Now, are they going to be cautious in certain property types and areas and all that? Yeah, because we don't know exactly what's going to happen yet. But you're going to have the best luck with any kind of loan right now if you're doing business with a balance sheet lender.
Correct.
Right. I actually just got a call from U.S. Bank this morning, a representative at U.S. Bank. They've just moved to Charlotte. And they have an interesting long-term buy and hold product. You'll be interested in hearing this. So it's a nice product, but the problem is on this one is they are taking the vacancy rate to 25%. So they're moving it from a 10% to a 25%. And then on top of that, you've got management fees.
So this is on portfolio lending?
This is, they'll do an individual standalone investor.
Like a one property?
Yeah, single property.
But they're going to slap a 25% vacancy on a one unit?
Yeah, so it's really, really, when you come out to it, it's like a 31% hit they're going to give you, which means it's going to be hard for anybody's houses to qualify for that, even if you're,
Yeah,
even if you're in it at 70%.
the only houses that would probably qualify under that program would be houses under 30 or 40,000 value. That cash flow amazing,
Yeah.
But then the bank probably won't do it because the house is only 30 or 40,000.
Or a duplex might work. If you've got some good income off a duplex, that would work.
What it boils down to is they're just not going to lend you as much money.
Yeah.
So it's just lowering the loan to value.
Yeah.
So the only way it's going to cash flow in their mind is if sorry,
and they'll
I brought my phone to the broadcast.
Well,
tell mom we'll call her later.
I would rather have someone lend to me based off a lower LTV than than to slap a 40 or a 25% vacancy that kills your DSCR.
Totally
and now you can't qualify for because I'm sure there's a DSR requirement, DSCR. Probably 1.2, 1.25. There's no way you can hit that.
Yeah, it's gonna be tough, and hopefully they'll loosen up.
Well,
on
that's
that.
it. It's the same thing. They're just not going to lend you as much money.
Yeah.
And that way.
Well, they won't lend you any money if you can't hit the DSCR.
That's right. It's not going to change the loan to value.
Well, that's true.
Yeah.
He raises money for us.
Shut up.
It's
Shut up.
They're really trying to reach out and work with investors, which I thought was pretty good. I was glad to hear that.
They should.
They're doing some small business loans. They're looking to fund multifamily type stuff and single use facility stuff, which we don't do.
Yeah.
But again, they're a bank.
They're a bank, U.S. bank.
They're a balance sheet lender.
They are.
And they have to have a certain amount of reserves. And
well, it's nice. It's easy to be a balance sheet lender when your balance sheet is guaranteed by the federal government.
Well, she said this too.
A certain amount.
She said this too, is that they service and hold on to all their loans.
That's big. Yeah.
So I thought that was very interesting, and they're getting high on service. So if you haven't tried U.S. Bank lately, give them a shot.
Yeah, absolutely.
That's the little tip for the day, right? But come to us first. Make sure we can't do it first. But that she sounded like very, very customer oriented. I was impressed.
We'll only put a 15% vacancy rate on it. So
that's right. That's right. No, it's important that all of us lenders, no matter what our products are, that we try to work together and spread the love. And the bottom line is to help the customer.
They will. I'm certain they will adjust those guidelines as they see down the road that rents are being paid on time.
We're
going to have to get through this first.
And the rental market's the hottest market there is right now too. And that's hard to say with how great sales are going.
Yeah.
Because sales are really rocking and rolling.
Well, I mean, you had this influx of institutional capital, the secondary markets taking on that rental product, flooding the market with all this money, and then they pulled back. People are still doing it. It's just a lot less. So it feels like, you just had billions of dollars just pull back.
Yeah.
Of course you're going to feel it. It's going to feel like the whole thing's dead.
Yeah. 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 It's crazy.
And, rents are down, and they continue to go down, but they're typically going to be in the major markets that are very expensive. People are moving out of those major markets because they don't necessarily have to be there any longer to work for companies, because they're allowing them to work remotely.
Mm-hmm.
And then at the same time, why would you pay the higher rent in these areas when all the reasons for being there are closed?
That's right.
The museums, the restaurants, the theaters,
the bars.
Why would you pay extra for that when you can't utilize it?
Yeah.
So they're fleeing those areas and they're moving into the suburbs. So depending on where the properties are located, they're going up. Some places are going quite a bit down in others.
And it seems like the A+ market is really that's the one that's kind of taken the hit right now.
Well, yeah, there's a lot of saturation there, and there really is 25+% vacancy there. That's true there.
Mm-hmm.
Here's the problem with that: the development costs are so much less. In the long run, you're getting in and you're getting a good return if you're developing it from the ground up. But once it gets stabilized, then you start getting higher vacancies and lower income from it, because you're going to find that a lot of people are just going to move out of that stuff. But if you're on the development side of it, that's great, assuming nothing happens while it's being developed.
Right.
And that's something that you have to worry about too, because markets change while things are going on, and there's not much you can do about it. Right.
Mm-mm.
And that's why we do short-term lending.
That's right. So we can pivot.
All right.
Yeah.
Let's get to something ugly.
Okay, so our first ugly question is I love this one. What happens to my investment if the borrower stops paying or is delayed in paying? And there's actually two ways we can answer this, is one from the one-off side and one from the fund side.
So this question is stipulating that you are in a first lien position, right?
Yes.
Yeah. So if you're in a first lien
Well, that's
position,
another thing to
Yeah.
bring up when
Yeah.
we get there. Talk about the second lien too. Go ahead. Go ahead.
well, I mean, if you're in a first lien position, you're in the driver's seat. I mean,
Mhm.
there's a lot of remedies that you can employ. I mean, you can work with the borrower.
Send Tony and Guido over.
Send
to-
Tony and Guido if you have some cousins that can do that. I mean, you can do a deed in lieu if you believe the equity in the property is something that you can convert to a rental or something like that. You can do a deed in lieu. I always recommend it as a lender. Usually, you're doing it because you want to be a little more passive,
Mhm.
so you don't want to own a property.
Right.
So then, how do you stay a little more passive and not own a property? You work with the borrower.
Right.
So
what are some ways that you can work with a borrower?
Yeah.
What do you say? What
mean,
do you do?
I mean, for us, I mean, you have to talk to the borrower and say, what is
What's
the
your
issue?
problem?
What is the issue? Is it a
Yeah.
is it a cash flow issue?
Mm-hmm.
Is it a life event issue? Like, what is the issue? We have to identify that. If it's a cash flow issue, and the property, let's say it's a fix and flip and it's complete, okay, well, we can work with you. Like, get the listing, get it listed,
Mhm.
and we can move, a portion of the interest or the whatever it is to the exit of the loan.
Mhm.
All of it, depending on the situation. I mean, you have a lot of options there. I mean, so cash flow, you just work with. I mean, as a lender, I'd rather have my money a little bit later than take a property back.
Yeah. What if
Yeah.
they're halfway through the renovation? If I see somebody that's halfway through the renovation, my first thought is, oh my gosh, I don't like being a rehabber. I don't want to get in that position.
Yeah.
Am I still going to want to work with him in that case?
I mean,
My answer is yeah.
my personal opinion is, to the effect that you can, you drag that borrower across the finish line.
Right. That's so well put.
Yeah. I mean, you just drag them as because you don't want that responsibility. You
Right.
don't want that property. Now, there's always, situations where people say, hey, well, actually, I would take that property back. And that's a different scenario. But 99% of the time, drag the borrower across the finish line.
Right.
So if it's halfway done, I mean, again, what is the issue? Are they in a cash crunch, or did their contractor walk out on them?
Hmm. Are they getting a divorce?
Yeah, they get a divorce.
I mean, there's all kinds of things. We even had one where the daughter got arrested.
Yeah.
And that was an issue.
Yeah.
It got worked out, but that
Yeah.
was an issue because there was a lot of attorney money
Yeah.
coming out for that. But there and what if it's multiple a borrower that has multiple properties? That's one good reason not to lend
Mhm.
to the same borrower on multiple properties at the same time.
Yeah, figure out what your threshold of risk is. I mean, if you have $1 million, do you want to lend one person $1 million? Probably not. If I have $1 million, I want to spread that out across at least 5 to 10 different people.
Right.
Like you want that spread out.
Just
now-
like when you're buying notes, you buy
Yeah.
10 notes to make sure you're
Exactly. So, and again, in the loans that we do, if the property's halfway done, that means that we're holding on to half of the rehab escrow,
Mhm.
which means if there was $100,000 rehab, we're still holding at least $50,000 to finish the property out. So we have that money there. So the whole point of that is to maintain your LTV, loan to value ratio, along the whole scope of the project.
Right.
So even if it's halfway done, you're only exposed at the LTV that you first did the loan, or at a lower LTV.
Right.
You're never going to be higher. So then that gives you options. Do I hire another contractor to come in? Now you have to realize that $50,000 that you're holding when you bring a new contractor in probably isn't going to be enough.
Right.
I mean, they don't like I mean, you know that.
They don't like coming in after somebody else.
Yeah.
No contractor thinks that the guy before him did a good job.
Yeah.
For
But they
sure.
don't mind buying it and finishing up somebody else's
Yeah,
work.
but the
Yeah.
other thing too is if you are dragging them along, they're halfway done. You're kind of dragging them along. You change the way you release the money too, right? Because
Yeah.
now we're paying all contractors direct. We're paying all the help ourselves. We're not sending that money to the borrower and allowing the borrower to pay.
Yeah.
Right?
I mean, in scenarios where I look at it, I mean, if we're halfway done and the borrower just can't get there, and I have to drag them across, what is that effort worth? Is it worth making the interest rate that you were making to do all that? Probably not. At that point, I mean, I would consider a forbearance agreement where I put in considerations for either an additional fee at the end, an equity position at the end,
Mhm.
because now you're doing more work.
Right.
You need more compensation.
Right.
I mean, that's
Now, you have to consider this. The states we do business in is not as critical, but if you take an equity position in the property,
Mhm.
then you, in some form, kind of own it too.
well.
Yeah.
I'm
So
not
you-
an attorney. I only play one on TV, but you can put in language into your loan, and actually we have it. We can add it into our construction loan agreement where it is a further inducement for lender.
And that's what I was getting to.
Yeah.
You don't want to sign a joint venture
No,
agreement.
no,
Right.
no,
Because
don't.
once you do that, then now you're sharing ownership and you're also sharing liability.
Right. Right.
And
You want to stay in the lender position. You don't, like Bill said, you do not want to own the property.
Right.
because somebody could slip and fall on the job and now you're on the hook as
Mhm.
well, for lawsuits.
And
Make
then
sure
you-
your builder's risk is up to date.
and
Yeah.
you're carrying the warranty on it for a year.
And not even that. I'll give you an example. In California, the builder is liable for workmanship and materials for 10 years.
Really?
Yes. And if you
That
started off
state
as a
was crazy.
lender and you ended up as part owner, then you're responsible for workmanship and materials for the next 10 years. And
Yeah.
the whole reason you get into the lending position is because you want to be able to control the asset without being responsible for
That's
the asset.
right. Good point.
And
Mhm.
another way of doing it, again, because you're in the lending position because you don't want to own the property. You can always sell that note to somebody else at a discount and just move on.
Yeah.
Yeah.
So what happens?
you're good.
I'm sorry. What happens to your investment? I mean, that's really the question. So what happens if I have to sell it for less? What can I expect to get back out of that? Now we're talking in the one-off realm here. We're going to discuss being in a fund position as well. But what happens if I were to sell it at a discount?
The note.
Yeah.
I mean, it really depends. I mean, it's who you're selling it to. I mean, if someone had a property that was 50% complete and they wanted to sell the note to me, I mean, here's the issue that I'm thinking through. Okay, I have a half finished property. The amount is X, and I have to take it through foreclosure,
Mm.
or I have to convince that borrower to work with me to do it. So right there, you have more work and you have more fees. So I'm not going to pay par or 100% for that loan.
Right.
I'm going to be paying a lot less than par. I mean, it really depends on what people will pay for it, but I mean, I see usually, mid 80s to low 90s for something
Mhm.
like that.
So when you say mid 80s to low 90s, you're saying you can get mid 80% back on what you have in it.
Yeah, best case scenario on something like that, you might get 90 cents on the dollar
Okay.
for your note.
Okay, that's easily understandable. And
Yeah.
we talked about too whether or not you're in first or second position.
Mm-hmm.
We've had to take houses back before that had seconds on them after us.
Yeah.
And I had
Don't
to
mess
make
with
that.
Wendy.
Yeah, I had to make that phone call saying, "Look, it's going to cost me $4,000 to foreclose on this house. I know you have a second on this for $50,000.
Mhm.
I'll either give you that $4,000 or give it to the attorney and wipe you out completely. What would you like to do?"
And to speak on foreclosures, if you are not in the first lien position, you are not in what we call priority position, you are subordinate to the first lien, and if you're in the third lien, you're subordinate to the first and the second lien.
Mm-hmm.
So what happens in a foreclosure sale? Let's say the total loan on the first and second is $100,000, 80 for the first, 20 for the second. The property goes to foreclosure, and the foreclosure sale, the first lien lender bids $80,000, what they're owed. I
Mhm.
mean, that's pretty normal, right?
Mm-hmm. Mm-hmm.
And what they get is $80,000. The first lien lender just got paid off. The second lien lender got nothing,
Right.
and their lien is now extinguished. It is gone.
Right.
So that's
Well, if you're in a second position, you could always be the one doing the foreclosing.
and in the second lien
Yeah,
position,
that's true.
Yeah.
you can buy out the first lien position, or if it goes to foreclosure sale, you can bid the the $100,000 that we talked about,
Mhm.
if you believe that there's a way that you can make more than that on the property
Right.
itself.
Right.
So it's just, you buy the first lien lender out,
And you have to have the money to do it.
and most importantly, you have to have the money to do it.
Yeah.
Well, the biggest thing is to make sure that there's plenty of cushion between the money that is lent out total if you're in second position.
Mhm.
In first position, that's all you're caring about is your loan. As
Mhm.
long as you have plenty of cushion to be below enough market value that when you do take this back, sorry,
His stomach
My
is
stomach
growling.
is
I can
growling.
hear it, buddy.
I'm on
Poor
this,
thing. He's hungry.
what is it called?
A diet?
Intermittent fasting. So I don't eat until well after lunch. So anyway, squirrel. So, what the heck was I saying? Oh, so you got to make sure you have plenty of cushion
He's old and
between
hungry.
Yeah.
Sorry, go ahead.
I'm done.
Yeah. No, Bill's right. I mean, the equity position that you hold. So how we call it a CLTV, which is combined loan to value. You want to make sure that even if you're giving someone a second lien, money on the second lien,
Mhm.
that your combined loan to value, so your money plus the first lien's money, is less than, I pull a number out, 80%.
Yeah, I
of
wouldn't
the,
go over that.
whatever you're comfortable with. I mean, some people might only be comfortable with 70. Some might be comfortable with 90.
And it disappears quick. So especially depending on the price of the house. If it's a lower
Yeah.
price house, you're really crazy for being in second position because you really don't have any room to play.
What always tell people are like, if we take this property back, we can make X amount on it. I said, if you take this property back, it is now an REO. It is not going to sell for the retail price.
Right.
It is not going to do that. So that equity position, like if you lent at a CLTV of 80, just because it's REO might eat up 10% of that equity just because it's REO.
And then you've got another 6% or 7% going to a real estate agent.
So it gets thin real
yeah,
quick.
yeah, it disappears. It
Well,
disappears.
part of the good news now is that
and then closing
there's a
costs that
housing-
you pay and stuff. So.
housing shortage. So
Yeah.
I think the prices are going to stay up as long as it's in the right place and you're close enough to the finish line
Mhm.
on the project. That said, as a lender, you have to also calculate your missed opportunities. So if you're debating whether to sell the note off at a discount, how long can I go without getting payments to my investment
Mm-hmm.
back?
Mm-hmm.
And what opportunities am I missing out on with that money on the sideline?
Yeah.
And does it make more sense for me to take a little bit less on the front end and sell it at a discount, take that investment and put it into something that's going to pay me?
Yeah.
Well, and to simplify that down a little bit further is if you take 90 cents on the dollar, so you've lost 10 cents. How long would it take you to make that 10 cents back? So if you're lending, and let's say you're returning your money twice in a year,
Mm-hmm.
and you're charging 5 points, it take you 1 year to make that money back. Like that's,
Right.
essentially what it would be, on the points, not on the interest, but it
Yeah.
would take you a year.
Yeah.
Is that more favorable than going through the foreclosure process,
Which could take a year.
which depending on your state can take between 3 and 5 years.
Yeah, 3 months to 5 years. You're
Yeah.
exactly right.
So, what's that time worth to you?
Yeah.
Keep
Yeah.
in mind, most people aren't getting 5 points, but it'd be nice.
Yeah, but and I will, we speak from experience. We went through this
Yeah.
and took houses back and decided to finish them. And if we had it to do all over again, we would never go down that path. It was too much at one time to handle.
Yeah, when you're a lender, I mean, your time was now devoted to property management and rehab,
That's
as
exactly
opposed
right.
to lending.
That's exactly right. And I'm a lender. I'm not a
Yeah,
not
you're
a
not making any
rehabber.
money that way.
Yeah,
And then
none of us were.
if you sell those homes at a profit, is there really a profit in there?
Right.
Because, again, you've missed out on that opportunity
Mhm.
to invest in other things that are paying you.
And then you're taking a chance on the market changing and
Yep.
all kinds of things like that. So you've got a lot of unknowns when you go down
So
that
that's
path.
a good segue into, if you're doing this as an individual lender, those are the things you need to look at.
Right,
For. If you're doing
right.
an individual asset. The better way to do this is to have that herd mentality.
If in the fund.
Circle the wagons.
That's right.
And you put it in a fund where if you do have someone or two or three or four even that's not paying,
Mm-hmm,
it's barely a blip
mm-hmm.
on the return.
Yeah.
Because you do have loan loss reserves that are set aside in most funds. When you're researching funds, that's one of your first questions.
Yeah.
Do you have a loan loss reserve?
Yeah. Yeah.
And if so, how much?
Or what percentage of
Of the
assets
fund,
it
yeah.
should be
management?
it
Yeah.
should be close. The percentage should be close to what their normal default rates are.
Yeah.
And in most cases, in our industry, it's 2% default
Mhm.
rate. So
Mhm.
it should be in the 1.5% to 2%
Right.
of whatever you have under management.
And bear in mind, whatever the fund is returning, if they're returning a higher yield, they need a higher percentage of loan loss reserves.
Yeah, because they're typically doing higher risk loans.
Exactly.
Right.
So the more risk and dictates the higher reward, but also needs to have a higher loan loss reserve.
Mm-hmm,
Yeah.
mm-hmm.
And at the same time, the circle of the wagons and the herd mentality is because you've got many people that are spreading their risk out over many loans.
Right.
When you're doing one or two loans, then you have a chunk of change invested in one or two assets.
Right.
And that's definitely going to affect you more than the other way around.
And it goes back to that passive and active. How active do you want to be? Like,
Mhm.
if someone asks, what is that? How safe is Carolina Capital?
We're not safe at all.
Yeah, we don't like to use that word.
Safe is not something, all real estate or any investing has risk to it. Safe isn't a word that
The SEC allows us
SEC
to
would
use.
like anyone to use.
It's like it's a
There-
4-letter word.
I'll tell you this: there's risk with every investment, and you
Mhm.
have to read the PPM to see what the risk factors are, because the PPM or the I forgot what it's called again. What does that stand for?
Private
Private Placement
placement
Memorandum. Golly. I'm sorry, folks.
I'm gonna go get him an apple
I
and
had a
something to chew
really-
on.
I stupidly did a really tough workout last night outside, and I'm still
He's
struggling.
bragging. He's just bragging
So-
now.
Anyway.
Our fund manager, what's PPM stand for? again?
So the private placement memorandum is a document that describes all the possible risks when investing in a fund.
Mhm.
And they are purposely drafted to make, basically, it's like a home inspector trying to talk you out of
Right.
buying the house or investing in the fund.
Right.
Yeah.
Right.
But it's designed so you go into an investment with eyes wide open.
Right.
Exactly.
That being said, we are very conservative in what it is that we invest in. So, comparatively speaking, we're more conservative.
Yeah.
And all the things that we're talking about here are things that we employ to mitigate risk on a daily basis in all of our loans. Again, we don't just say drag the borrower across the finish line because that's a fun thing to say and we think people will like it. It's because we do it. Like,
Yeah,
you know, if
yeah.
there is an issue, we drag that borrower across the finish line.
Yeah.
Because we don't want the property back. Just for what we're telling you all is, it can be missed opportunity,
Right.
and we don't want that.
And depending on how they behave,
Mm-hmm.
how and whether they approached us first.
Yeah.
That's important.
Communication.
You know,
is the
when they
big-
approach us first and say, "Hey, I'm running into some issues.
Mhm.
What can you do to help me?" What we all learned from the experience, you know, we may even lend to that person again.
Yeah.
Because, you know, depending on how they behaved, you know, bad things happen to good people all the time. But if, you know, we've got somebody that's kind of dodging the bullet, doesn't tell us anything until the very end, won't answer our phone calls, we will not even, we'll bury them.
Yeah. Oh,
And we'll make sure that they're not getting a loan from us or anybody that we know, like, and trust.
well, and I want to say also, if the payment does stop, and it's, you know, let's say whatever your note says, 30 days past due, do send out a delinquency notice,
Yes.
because that gets the clock running. If
Yeah.
you don't send that out, that's an additional 30 days that if you do have to go to foreclosure, that now you have to wait, because now you have to send out a default letter and say, hey, you have 30 days to cure, because that is a requirement, and it just adds it. So
Right.
go ahead and do it. You don't have to foreclose. You don't have to do anything, but give yourself options, not obligations.
Right.
So that's what I
Right.
like to
And
do.
then talking to the safety of the fund, I hate to use that S word again, but you know, we took back a lot of houses in 1 year. That was the beginning of 2018, I believe,
Yeah,
and
that's right.
spent that whole year working a whole lot of stuff out. So what was, you know, what could have been devastating or caused a company to close down, the fund was able to not only survive it, but to come through it much stronger.
Mhm.
I mean, you were talking yesterday. What did we end up making that 1 year? What was our return? Are you allowed to say that?
No, not really.
But it was good.
I can say that we ended up with, even with having to take back a whole lot of properties, the fund still had a gain for the year.
Yeah.
It still beat the three indexes.
Yeah.
The S&P, the Dow.
For the stock market. That's exactly
and
right.
the NASDAQ. And while alternative funds do not compare themselves to the stock market, even with a downturn,
We still,
it still ended up with a gain. And
So-
you don't usually get that when you're in the stock market.
yeah. So having
Yeah.
something, you know, even devastating like that, it was, you know, we were able to come through it, and it's the herd mentality.
Mhm.
And we worked through everything instead of selling it off like in hindsight we would have done anyway.
Yeah.
So let's see what Laurie has to say. How do you take an equity position as a potential alteration to a loan without being an owner?
Well,
You
you're the note guy, so tell us how you structure that note without taking ownership.
So first, you have to get the borrower to acknowledge that they are in default. You know, they did something that they weren't supposed to do for the covenants of the loan. And
Now, wait a
usually-
minute. This doesn't necessarily have to be somebody that's in default. This could just be a way to draft a note from the beginning where you still get an equity position.
you can do
for
that from the
a
beginning.
percentage of
Yeah.
sale at
Yeah.
the end as part of your negotiation.
Sure. There's two ways to do it. You can do it at the beginning, but I'll focus on what do you do if you have that oh no moment.
Right.
This is happening,
Yeah.
and what do
Yeah.
I do now? So you have to get the borrower to acknowledge that they're in default. They don't necessarily have to be in default, but what I typically would do is I would send them a forbearance agreement, and I would say, hey, I as lender will forbear from pursuing default remedies on you for whatever covenants that are broken, in consideration of you, doing this, this, and this. And one of those considerations can be in consideration of, at the sale of the property, 10% equity is paid to the lender as a further inducement to do this forbearance. That's how I would do it. I would do it through a forbearance agreement.
Good. That was good.
Yeah. So if you do it on the front end, it's a lot easier. And I will say this, like, you can do equity positions on the front end as a lender, and it's not a big deal. Just make sure that you don't
Don't call it an equity piece.
Yeah,
You can't call it
a
that.
percentage
you-
of sales price.
Yeah,
you've got to
yeah.
call it something else because
Or appraised value,
no
sales
one
price.
no one
something like
wins if
that.
you go to court. I mean, that's just the thing. But you want the language to be clear that it is not a joint venture, that you are not an owner. So just avoid equity language. I mean, I would say 10% of sale, or proceeds beyond X amount. Whatever it is. I mean, you want to structure it that way. But yes, you can take those positions at closing of a loan, or if a hiccup happens along the way.
Yeah, that's good.
Yeah.
Good stuff, Jonathan. I can tell you didn't just make that up.
I actually made it all up.
That's really good. That's
no,
great.
No, it's like I said, we tell you from experience.
That's right.
We've done most of these things. If not, we've seen people do it.
That's right. We've stepped in a lot of piles of poopy.
See,
Mhm.
the beauty of being a lender, or say an owner, someone doing owner financing, is that you can structure a note
Any way you want.
any way you want, and you want to structure it where it's a benefit to both the lender and the borrower.
Mhm.
Yeah.
Those are going to be the best solutions.
Right.
You can buy investment property together with somebody, and one be a lender and one be the owner.
Right.
There's all kind of ways to do it, and this is what I love about the business. It's just whatever works out best for everybody.
Mhm.
Right?
You just have to have an open mind to think of what all the pain points are and how can they all be met, and they can be if you do it right. So I'm sorry.
If you all have any more questions, please let us know. Do you want to move to the next one?
Yeah, we've got 20 minutes left, a little less than 20 minutes. So this one is really pertaining on the borrowing side, and it's why all of a sudden is there a credit check for hard money? If a corporation is asking to borrow money, why does the CEO have to show their credit score and pay stubs?
So basically what that boils down to is, why are you checking credit if you are supposed to be an asset-based lender? And why are you checking credit if you're lending to LLCs and I own the LLC? Why do you need to see my credit score or my pay stubs?
Right.
Okay.
Because we care about character.
Well,
We like our money back.
we care about character, but I mean, I think everyone would agree, no one knows the future, but the best indicator for future behavior is past behavior.
Amen, brother.
So we want to see that your past shows that you have an ability to repay debts.
Yeah.
Can I do a little? Let me just do a little history. Back, when
History of the World Part 1.
before they had electricity, when I started in the mortgage business, you had to.
Last time he ate, too.
You only had two types of loans. You had bank loans. The bank would hold the loan, and these are conforming residential properties, let's say, and borrowers. So you could get a loan from the bank, but you had to put 20% down, and you had to have stellar credit and proof of income. And there was no secondary market for this. The banks held them themselves. The alternative to that was the FHA or VA loans, and those were government backed. So they allowed less money to be put down.
You're talking prior to 1970?
No, actually, I got
Not
into the
really,
business
Jonathan.
in '89, and then
I thought he was trying to get in before like the mortgage-backed security or something.
well, back then, again, when I got into '89, you really didn't have the mortgage-backed securities. You had savings and loans that got into that space. They crashed and burned because they got a little bit too risky on the commercial side of things. But then you had finance companies, which you don't see anymore.
Right.
But we used to call them stick lenders.
Really?
Why? Because they would lend money on your sticks, furniture, stuff like that.
Yeah.
Got it. That's good.
But then they got into the mortgage side of things. So you always had two types of borrowers. You had borrowers that paid on time perfectly all the time. Then you had borrowers that paid slow. They never defaulted. They just chronically paid slow.
Your 30-day payers.
Those were the people that went to the finance companies. They had to pay a higher rate because guess what? You had to work a little harder to get their payment. At the end of every month, you had to make your phone calls and say, hey, your payment's due. When can I expect it? If you worked for a finance company, sometimes you'd have to go rent a U-Haul truck or one of those big Penske trucks
Get that TV back.
and pull up in somebody's front yard and hit the air brakes and say, I'm here to get your TV or your payment.
Yeah.
Again, you had to work harder to get it. And that's why the
Mhm.
rates were higher. And then you got into the subprime companies started springing up from that, and all the finance companies went away.
Hmm.
So at that point, you could fog a mirror and get a loan.
Right.
Mhm.
Were there hard money lenders through all this? Yes.
And we
When-
pulled credit then, back in 2000. I
Well,
pulled credit
There was plenty of hard money lenders that could care less about credit
because they wanted your house.
because they're only lending at 45-50% of the value.
That's a good point too.
Yeah, if
And-
we lend at 40, yeah, I mean,
and at the
I don't
same
really care about
time-
credit too much. Yeah.
A lot of times the only loans that people would actually try to get from them because they could get a subprime loan were so unique property types that they wouldn't fall into those categories
Right.
either.
Right.
And again, so they didn't care about credit or anything else. They're strictly lending on the property. Well, times have changed. It's much harder to get loans. At the same time, no lender wants the property back.
Mm.
And so they have to do their risk evaluations based on the income, the assets, and the character of the people that are borrowing.
Right.
And they thought the 5 C's of credit only applied to banks.
And listen, there are plenty of other hard money lenders out there that won't pull credit.
I can't think of one.
I
You know one?
I see emails all the time from companies that are still asset-based lenders. But I can tell you right now that unless you have a ton of equity or you have a lot of cash in the bank to put down, you're not getting a loan from them because
Right.
They're basically only going to finance probably max 50-55%.
But I mean, yeah. So another piece of it is, why do we run credit checks? If you're rehabbing a property, the money that you get from a lender is held in escrow and dispersed after the rehab is done in phases.
Hmm.
So if you have credit cards that you use to do that work up front, that's fine. But if your credit cards are at 90% usage, how are you going to pay that?
Right.
Like, unless you have money in the bank. And, so that's another thing that we look at is, do you have the ability to front the money to get things going?
Right.
Yeah, and lastly, we're looking for exit strategies. If you get into a situation where you can't sell the property and you want to now turn it into a rental,
We want to make
you,
sure
you
you
have to be
qualify.
able to qualify for a long-term loan.
Yeah.
Yeah.
And so that's another reason.
Yeah.
And that's really, really important. There's so many people that have absolutely no intention of refinancing the house, and they can't understand why that would matter to us, but it really matters to us. Number one, we don't want your house. We're
Yeah.
not in that business. That's not what
how
we
many
want.
people have you talked to that their full intention was to sell the house, but they had to turn it into a rental?
Several.
It's more than one, isn't
Oh,
it?
yeah,
Like,
several.
happens.
It happens
I
a
know
lot.
plenty of people that needed to move and they were unintended landlords.
Yeah.
Because they had to rent their house out because they couldn't either get the price they wanted or they couldn't get it sold in time.
Right. So you've got to be able to qualify to get out of that loan. And the thing is that people say, well, I qualified for, my primary when I bought it, and that's all great and wonderful. But when you're qualifying to get into an investment property, they underwrite it a lot tighter. They care that you have 6 months worth of interest in the bank rather than the 3 when they're
Mhm.
doing an owner occupied. They also will take, your income into account. They care, well, how are you going to make the payment?
Yeah.
I understand that you might have a lease on this, but they're only going to give you 75% of the rent that
Yeah.
you get in toward the payment, the vacancy, the property management, all of that stuff. They're only going to give you 75% credit on that. So
Try to get a loan with no income, but the property debt service itself, and it has a 1.25 or higher DSCR, they won't give you a loan.
no.
You personally have to have income. So, that whole thing, like, I don't
And
need
it's got to be a 2-year job history.
it's gonna be
and-
W-2 income.
Yeah,
I mean,
yeah.
for someone to say like, well, I don't need income, the property debt service itself, and I'll just refinance it. No, that doesn't work.
Yeah. And people used to say too, well, I'll just use a quasi hard money lender to refinance out of it. Well, guess what? That's what's gone.
Yeah.
those long-term refinances for investor properties that are not going through a bank, that's what's been pulled from the market. That's what we're having trouble with. What's funny? Why are you laughing?
Quasi. It's like I'm listening to the Science Channel.
That's what's not out there anymore. So if that's the loan you're counting on, you're not going to get it.
Yeah.
Not now, not today.
Not today. I mean, we're working on one. Like I think we've talked before.
Yeah.
So we will have one here shortly. You know, less than 30 days, I'd imagine. But
Keeping our fingers crossed.
yeah. But
Praying hard for it.
yeah, I mean, it's like you have to have an exit strategy, and you know, a retail sale to an end user buyer. That's great. That is a great strategy. But there has to be plan B and plan C.
Yeah. So the CEO, why is it the CEO of the company that has to show?
Well, that's a good question. So if you're the managing member, manager, CEO, president, whatever it is of the LLC, the corporation, you are typically going to have to sign a personal guarantee on the loan, which means it's a full recourse loan. So it is important to know that the person who's signing the guarantee actually has money that can be, you know, pursued upon.
Right.
You know, if they don't do what they're supposed to do. The documents, as in everything, the contract, the documents is for a worst case scenario. And we only pull on them if the worst case scenario happens, but they have to be there.
Right.
So that's why it's there. We have to know that, you know, I can sign. I mean, we have a saying, personal guarantees are great, but good luck getting them to pay. And that, and I don't mind sharing that. Like, it is tough to get someone to pay on a personal guarantee. Luckily, we've never had to pursue that.
Right.
But it's nice to have.
Yeah.
It's one of those things that says it helps Bill sleep at night. And when Bill sleeps better at night, I sleep better at night. So
well, there are. By the way, there's other lenders that don't require any of this. But there are lenders like us that we will look at non-recourse loans. But
if it's an IRA borrowing the money,
LTV is, or there's going to be some adjustments because again, without recourse, there's a higher risk of not getting paid back.
Right.
Yeah.
And so you have to make adjustments for that, and, rate or LTV or maybe a combination. But there are some of those available. And yes, you can borrow with your IRA and you can make good money doing that. Keep in mind, if you're borrowing with your IRA, and again, I'm not a custodian and I'm not a tax person.
He just plays those on TV.
But if you do borrow through your IRA, you are subject or could be subject
to UBIT.
To UBIT tax.
Yeah.
Unrelated business
income tax.
BPM.
The other thing too, if I get a call from somebody wanting to borrow money, and they are complaining that they have to have their credit pulled, and that they have to show pay stubs or their tax returns or whatever it is we're asking for, my first thing is red flag. They've got that attitude that, hey, if it doesn't work out, I can just walk away.
Exactly.
And I don't want to borrow. I don't want to lend to anybody that has that kind of an attitude.
Well, and what
commitment's a commitment.
What blows my mind is people who, their whole goal is to turn it into a rental and refinance it, and they don't want to show, have their credit pulled or show bank statements or tax returns. Those are all things that you're going to have to show anyway to somebody.
Right.
So then it becomes like I can go to irs.gov and print off my tax returns in about 5 minutes.
Yeah.
So what's so difficult about that?
Right. Right.
I don't understand. I don't understand it. So when people, like you said, when people balk at it, I'm like, well,
what's the real problem?
What do you not want me to see?
Yeah.
Because we're not going through these things with a magnifying glass and just trying to make finding a way to not do the deal.
Yeah, we want to do it. We don't make money unless we make loans. Just so y'all know.
So here's the bottom line: bridge lenders, hard money lenders, private money lenders. Their loans are not they're not doing loans based on somebody's ability or compunction to pay. The reason you're
Big
paying
word.
more,
I'm impressed.
The reason you're paying a higher price for these loans have nothing to do with your ability to pay or your willingness to pay. It has to do with the risk of the property type,
Mhm.
the speed and ease of getting money quickly so you can be more of a cash buyer.
The fact that you're borrowing based on the value
And
after repair.
any loan that is got a construction component is a higher risk loan because it's not sale ready.
Right.
And any lender that is looking they always have to look at worst case scenario. If I have to take it back, how quickly can I sell it? If it is not completed and move in ready, then it's going to take longer.
Right.
So that just adds to the risk. To it.
Right.
No, it's true. Looks like Don asked, you mentioned making a loan to a self-directed IRA. Can you explain?
Yes.
Thank you, Don.
There are plenty.
Buy and hold or flip. He's adding that part too.
There's actually you can do loans in both. We've had customers that have done fix and flip loans through their IRA, and I'll give you a quick example. Let's say you're buying a house, you need $100,000 to do the fix and flip. You've got $20,000 in your self-directed IRA. You use part of that money as your points and down payment, closing costs.
To go to
The rest of the money in there is going towards your monthly payments. And then at the end of the fix and flip, you've taken, you've leveraged that $20,000 into a $100,000 loan, and you end up selling the place for, $170 or $160, right?
Right.
And now you've added $60,000 in profit.
If you sold the house yourself.
Assume it, yeah. Sorry, Don. Let's assume you made a $60,000 profit. You've gotten that original $20,000 that you started with, and I'm talking profit including the payments that you made to get it.
Right.
So now you've got an IRA that's got $80,000 in it, and you did it in 6 months. How's that?
Yeah, that's great.
That's a good return.
That's a decent return.
Now, it's hard to offset your possible UBIT, but the fact that you can jump that thing up that quickly, and if you can do it a couple of times a year, again, you got to be careful. You don't want to have the IRS think it's a business.
Right.
Because they don't like that either. But if you're buying rental properties this way and you're doing it with your IRA, leveraging it, you can actually utilize the depreciation and expenses that you have. You can actually now take advantage of that in your IRA because you can use that to offset your UBIT owed, because you're only owed a UBIT on the profit, right? So you're writing depreciation off, expenses, and all that stuff. So your actual profit each year is a lot smaller. And so that UBIT is not going to affect you. But that's a good way to do it as well.
So it's not as scary. UBIT is not as scary as everybody thinks it is. It's not a big, gigantic number.
Could not be.
So how do you qualify the borrower for a hard money loan?
If it's self-directed IRA, we're qualifying the individual, but the loan is just in the name of the IRA.
Yeah.
Yes. So the only difference on that loan, like we're like Don, we would qualify you as an individual utilizing your self-directed IRA. The only difference on the loan docs would be that there wouldn't be a personal guarantee.
Yeah.
And
Because
the
it has
loan
to be
would be in the
non-recourse.
name of the IRA
Yeah.
for the benefit of whatever custodian you have.
And so if it were a 6-month loan,
Or
we would want to
LLC.
make sure that you had enough money in your account to make payments for 12 months, really. Because if for some reason you can't get it sold, only money in your IRA can pay that extension fee.
Now, keep in mind, you're only allowed to put money in your self-directed IRA once a year.
Yeah. So
you have to make sure that if you're
not
making
gonna
a
run out.
contribution, it's a,
you hadn't made it yet.
It's going to be enough to cover it.
Yeah.
Just in case.
So we got the thumbs up. So apparently we answered your questions adequately.
And I
He already
typically,
knew
and I
all the
want to say
answers.
also, typically, if we do a loan to a self-directed IRA, without a personal guarantee is, now it's non-recourse. It's going to be a little more conservative than a typical loan with full recourse.
Right.
All right. Time's up.
That's right. And just for the record, Don
12:59.
Harris already knew all the answers to those questions. He asked that so we would share it with other people. Thank you, Don.
No, he was just
For doing
putting me
that.
on the spot.
Yeah, trying to see if you knew what you were talking about.
What's PPM stand for?
PPM.
Yeah. Okay, time to eat.
All right. All right, folks. Thanks for joining us. We're going to be doing a show at 1:10 or
Yeah, just a few more minutes, and it's really good.
Yes, sir.
It's these twin brothers out of New York that are doing great business, and you've just got to hear their story and see what they're doing. It's pretty awesome. Right?
All right. Yeah. Don't forget CarolinaHardMoney.com. Don't forget to share, subscribe, like, all that good stuff. We'll see you soon. Thanks.
Thanks.